Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, webinar participant. Thank you to committee for the time given to us to present our research. We are from Unisbank University of Semarang. My name is Tjahjaning and our teams are Mrs. Nuraini, Mr. Mariono, and Mr. Teguh Parmono Hadi. The title of our research is The Role of Corporate Social Responsibility as a Moderator, the Effect of Profitability and Company Size on Tax Aggressiveness. We have 3 points, the research topic interest. Point 1, that is, corporate tax aggressiveness is assessed by the extent to which the company takes tax avoidance measures by exploiting loopholes in tax regulation. So, by doing, the company will be considered more aggressive toward taxation. Point 2, that is, there are several factors that influence companies in implementing tax aggressiveness, including profitability, company size, and corporate social responsibility. And point 3, that is the research gap. The theory of our research used two theories, agency theory and legitimacy theory. As for our research hypothesis, there are 4 hypotheses and the following is our research model. Hypothesis 1 showed that profitability has a positive effect on tax aggressiveness. Hypothesis 2, company size has a positive effect on tax aggressiveness. Hypothesis 3, CSR is able to strengthen the influence of profitability on tax aggressiveness. And hypothesis 4, CSR is able to weaken the influence of company size on tax aggressiveness. The research method we use include our research sample is process data, have 179 manufacturing company in Indonesia Stock Exchange the year 2014 to 2017 by purposive sampling. Our technique analysis, we use moderated regression analysis. And variable measurement, tax aggressiveness, dependent variable, we use effective tax rates. Independent variable, profitability, independent one variable, we use return on asset. Company size, independent variable 2, we use learn total asset. And CSR, moderating variable, we use index GRE have 91 item. The result, hypothesis 1, the effect of profitability on tax aggressiveness. We found that profitability has a significant negative effect on tax aggressiveness. Therefore, the hypothesis 1 is rejected. We can explain that this shows that companies that have high level of profit actually have a low tax burden. This can be affected by income which should not be included as a tax object but rather as a tax object. The results of this study are supported by Chen et al. The year 2010, who argued that companies with high profitability have the opportunity to position themselves in tax planning, which reduce the amount of tax liability. We can explain also companies can reduce the amount of their tax burden by taking advantage of the income tax Article 4, paragraph 3 on non-taxable objects by selecting or generating non-taxable income. For example, a persero can invest in a company or business entity in Indonesia and dividends received by Persero will be categorized as income which is not subject to tax on the condition that the Persero has share of at least 25% of the total paid up capital in the company as regulated in the law income tax article 4 paragraph 3. The results of this study are in line with the hypothesis conducted by Lanis and Richardson the years 2007 and Kurniase and Saris the years 2013 research. The result hypothesis 2, the effect of company size on tax aggressiveness. We found that size has a significant negative effect on tax aggressiveness. Therefore, the hypothesis 2 is rejected. We can explain that the size of the company can be interpreted as a scale in which the company can be classified as large and small according to various ways, one of which is the size of its asset. The size of the company can determine the size of the asset owned by the company. The greater the asset owned, the greater the amount of productivity. Assets owned by a company are related to the size of the company. Large companies tend to have large assets. Assets will experience depreciation each year, which can reduce the company's net income, thereby reducing the tax burden paid. The high profit that the company receives will result in higher taxes that must be issued by the company. This condition makes managers try to minimize reported taxes, but by reporting high profit, one of which is by diverting them into withheld tax. This condition can cause the total tax burden to be smaller. We can explain also that there is a significant negative effect of firm size on tax aggressiveness because large companies have more room for good tax planning and adopt effective accounting practice to reduce company tax aggressiveness. The results of this study are consistent with research conducted by Richardson and Lanis the year 2007 and Rodriguez and Arias the years 2012, which states that the larger the company, the relative lower the effective tax rate is. The research result, hypothesis 3, we found CSR, moderating variable, ROA has a significant positive effect on tax aggressiveness. Then the hypothesis 3 is accepted. CSR strengthens the influence of profitability on tax aggressiveness. Research conducted by Bajuri the year 2011 states that companies in Indonesia have begun to consider the importance of the existence of corporate social responsibility, so that the greater the benefit obtained, the higher the value of the performance of CSR. CSR can also be used by companies to be superior to competitors in terms of getting benefits. Once a company in an industry has successfully implemented a CSR policy, a competing company may be forced to engage in CSR activities as well. We can also explain that the company is running its business has the aim of obtaining maximum profit. However, companies also have an obligation to pay taxes. The tax burden paid by the company will have an impact on reducing company profits. To maintain or optimize company profit, efforts to minimize the tax burden are carried out through tax avoidance practices. According to Watson, the year 2014 in Amalia Sari, the year 2017, it is found that companies with good quality corporate social responsibility do not evade tax in condition of high profit performance. Moreover, there will be accountability report that will make the company more transparent. Likewise, according to research conducted by Akusti, the year 2014, there is an influence between profitability and corporate social responsibility on tax avoidance. The result hypothesis 4, the influence of corporate social responsibility weakness the influence of company size on tax aggressiveness. We found that CSR, moderating variable to size, has a significant negative effect on tax aggressiveness. So the hypothesis 4 is accepted. We can explain that companies are classified as small or large from one of them from the small amount of the company's total sales. Benchmark used to show the size of a company, including total sales, number of regular customers, and total asset. The result of Sunarto and Budi, the year 2009. The greater the total sales or asset, the bigger the size of company. The result of Mulyanti, the year 2010. Corporate social responsibility activities are a manifestation of the company's concern for the community apart from paying taxes correctly and properly. Corporate social responsibility is a form of communication relationship. This is done so that the company has a positive image in the eyes of stakeholders and the wider community. We also can explain that in line with the theory of legitimacy, besides obtaining maximum profit, companies are required to pay attention to the community. Company size can be affected by tax aggressiveness. However, when other factors occur, such as the existence of corporate social responsibility, it will weaken the relationship between company size and tax aggressiveness. With good corporate social responsibility, it will strengthen the value of tax aggressiveness, which means that the company will be more transparent in building good relationship with the community or stakeholder. The result of Prameswari, the year 2017. We have limitation and suggestion for the next research. Our limitation, that is the difference in assessment in analyzing in and identifying CSR disclosure item in annual report that are subjective, so that they are only based on the author's knowledge. The R-square value of this study is relatively small, 7.2%, the meaning that the variables in the study only affect 7.2% and the remaining 92.8% are influenced by other variables outside the result, and the result only use company engine in the manufacturing industry. Our suggestion to next research, it is hoped that they can increase the number of other independent variables that affect company aggressiveness, such as leverage and earning management. And at observation, in this study, it was only 4 years, 2014 to the year 2017. And not only research in manufacturing companies, but also in other companies, such as banking. Thank you for listening our presentation. We hope your suggestion to improve our research. Wassalamualaikum warahmatullahi wabarakatuh.